jam-packed day ahead here as the opening bell will ring in about 12 minutes. We're excited for ARM's IPO. We are watching the market's response to a hike from the ECB and pretty solid economic data here. And then later tonight, looking for any insight as to how the potential auto strike goes. Joining us, Ann Sonders, Chief Investment Strategist at Schwab's Center for Financial Research, on the phone. Ann, among all the options here, what's most important to you? What are you keeping an eye on in the second half of this week?
Well, today was an interesting pre-market day just because it came across a little bit as a shoot first, ask questions later with regard to retail sales. You saw a spike in yields and you gave up some of the pre-market gains in the S&P, but then I think when digestion of the numbers was done, maybe with a little more of a fine-tooth comb, you do continue to see a deceleration, and that may be why you didn't see the needle move on probabilities, not just for next week's Fed meeting, but the following Fed meeting. I think, for obvious reasons, the Fed meeting next week is important, not so much because of the decision or lack thereof that is made, but the commentary we'll get from Powell during the press conference, and whether he mildly keeps the door open, and then in particular how he discusses the expectations for 2024.
Do you think those words, those expectations from Powell will start to veer more hawkish, or what's the messaging from the market? Because we got this strong dollar this morning, which is a kind of a head scratcher if you're kind of thinking about it in the traditional way after the ECB's hike.
I guess it depends on how you define hawkish. I wouldn't expect, based on the data that has come in, that he would overtly tune to a more hawkish tilt. Whether you think that if he leaves the door open and expresses that the door is still open for additional hikes, whether that is deemed to be a shift more toward the hawkish direction, I guess it's everybody's perspective on how to apply those labels of dovish and hawkish. I think he more recently has been emphasizing the for lack of a better term, the long and variable lags component, and that they're at the point in the cycle where they want to take a breath and assess incoming data. It also is the case that as much as we continue to obsess about the inflation prints, CPI, PPI, PCE, I think labor market data is at least as important at this point in the cycle. It brings back that other part of their mandate. And I wouldn't be surprised, even if he doesn't address it more directly, whether more of the questions during the presser are geared toward the labor market side of things than the inflation side of things.
Does it look like the labor market has a particular direction right now? Off the strongest points, we've certainly softened, but it seems like the rate of that softening is kind of slowed a bit.
Well, you have to take revisions into consideration, too, and that's very important when you're at a potential inflection point in the economy. Every report this year has been accompanied by a prior month or prior 2-month revision, such that every month so far has had downward revisions to the tune of, I think, cumulatively it's more than 350,000 jobs revised out relative to what the first releases were, and that's just this year. And then if you look at the BLS's annual benchmark revisions, which goes back to March of this year and does a level reset, there were more than 300,000 revised out there. You still have a much lower hours worked component. That's a way to gauge underlying weakness that might not be picked up in a plunge in payrolls or a move up in unemployment claims. It could be reflective of the whole labor hoarding story in this cycle. But I think there's clear deceleration in a metric like payrolls. And even though the unemployment rate moved up to 3.8 for the so-called good reason of labor force participation picking up, it is the case that regardless of the reasons, once unemployment shifts, inflects, it doesn't tend to be choppy. It tends to continue to move in that direction. So I think even though it's a lagging indicator, I think the unemployment rate will be increasingly in focus with any upcoming jobs report.
What potential impact do auto strikes have? Are you thinking about this at all right now, Ann, as a major event for the market or for sectors?
Well, the rough estimates by economists suggest it could haircut a bit off of overall national GDP, not to mention what it does to state GDPs, particularly a state like Michigan. Obviously, the length of it would be a factor there, but I also think it pulls into the discussion something that we've talked about before, which is, are we potentially in a transition to a different secular environment away from the great moderation and back to something that maybe looks a bit more like the 3-decade period that started in the mid-1960s? And one of the metrics or comparisons that I think is worth keeping an eye on is labor share of GDP relative to profit share of GDP. Those two have started to converge, with profit share of GDP coming down from a record high, labor share moving up. They're not anywhere near what we saw back in the pre-Great Moderation era, but if that convergence continues, that could be a sign that the backdrop in terms of the relationship between profits and labor as a share of GDP is shifting.
Okay. So we've got some kind of wild cards in the employment and economic outlook. We've also kind of got some wild cards here for the market, some that intersect with the economic situation, like the move in crude oil. Energy stocks, obviously, you're going to like that. You've talked to us before about how some of the energy companies maybe have a little bit better advantage in this environment right now. How does that fit into this? Is the crude move more important for the inflation conversation or more important for the stock convo?
Well, I think both. And the fact that it's not just oil prices that have gone up, but the trifecta of oil, dollar, and yields that I think have collectively put downward pressure on equities, notwithstanding pre-market strength today. It also is the reason, obviously, why you see much stronger breadth for energy relative to pretty much any other sector, because that's where the juice on the upside. And in terms of the inflation impact, it's a big duh to point out that rising oil prices impacts headline inflation. But as we saw with the CPI data, it can filter into core inflation as well because of what we saw with airline prices. So you do have to take into consideration those filter effects. It's not as simple as just Xing out of headline, looking at core, and not seeing the implications that, particularly if it's a continued rise in oil prices, not to mention just the hit to the consumer. And even though retail sales were better than expected, they have decelerated, and you add into the mix the pressure of higher energy prices, student loan repayments kicking in. I think it's a mix for weaker consumption data, and that may be why the needle didn't move in terms of Fed policy expectations.
Lizanne, when we look at the combined move, to your point, of these three kind of inflationary pillars, the dollar, the yields, and crude, all stuff that happened last year when the market for stocks was buckling, we've got a VIX 13 handle. And we're not making new highs, of course. We're just kind of grinding sideways, which can bring us a lower VIX. But just kind of like generally speaking, does a VIX 13 resonate with you as what you might have expected for a higher for longer environment? Like, it seems like the Fed can't cut, right? That's kind of the main message here. Maybe they don't have to hike. But is higher for longer VIX 13?
So that's a great question. And I think if you had said to me, I don't know, a year or two ago before the start of the hiking cycle, whether it's easy or hard to explain why equity volatility is so low, I certainly would have guessed that equity volatility would be higher. But then if you bring into the mix the MOVE index and look at volatility on the fixed income side, just at this point in the cycle, you're just seeing that volatility spike be more prevalent on the Treasury side of things, not on the equity side of things. So I think you have to look at, and it has eased a little bit, but that's where the volatility has been concentrated. And maybe that shouldn't be a surprise given a most aggressive tightening cycle in 40 years, and the Fed being data dependent, and inherently the uncertainty that brings into the mix on a short-term basis as everybody tries to game what the Fed's next move is.
Okay. Be remiss not to ask you real quick about the IPO. I know you're not stock specific, Lizanne, but if you can give us maybe some perspective on market froth right now. Does this look like a fertile environment for a $50 billion, 100 trailing price to earnings debut for a company?
The short and honest answer is I don't know. There's obviously been a lot of attention and hype. That's one of the purposes of doing an IPO, and from a company's perspective, is not just to raise capital, but to raise awareness and get the sort of advertising out there via an IPO. And there has been a incredible dearth of supply of IPOs, particularly coming off the sort of death of SPACs relative to that bubble. We'll have to see what the price action is as to whether it reinforces what is often the case, where you get the big spike early on and then it fades fairly quickly. And I think it's that sort of post-action that's going to be more telling around what the broader sentiment environment is.
All right, great stuff. Thanks, Lizanne. Good to have you here. Appreciate it.
Thanks, Oliver.
Thanks for calling in. Ann Sonders, Chief Investment Strategist at Schwab Center for Financial Research.